Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Investing in real estate can do a lot for you, but not everybody has the time or is even interested in going full-time as an investor. Well, the good news is you don't have to. Today we'll talk about fun and profit for busy people through passive investing. And we've got a great guest on the Real Estate Guys radio program. The Real Estate Guys are throwing a party and you're invited. Join us at the New Orleans Investment Conference, November 20th to 23rd. Now in its 50th year, it's the nation's longest-running investment conference and features some of the biggest names in economics and investing, including James Grant, George Gammon, Danielle DiMartino Booth, Rick Rule, Lynn Alden, and Doug Casey. Plus, I'll be speaking in multiple sessions, attending lots of others. And the Real Estate Guys are hosting our annual invitation-only party one of the evenings for our friends and listeners, including some VIPs for you to mingle with. So make plans today to join the Real Estate Guys at the 50th Annual New Orleans Investment Conference. With all that's going on in the world, no serious investor can afford to miss it. Send an email to neworleans@realestateguysradio.com and we'll get you all the details. And I'll see you there. Welcome to the Real Estate Guys radio show. I'm your host, Robert Helms. Obviously, we love real estate on this channel, and we love investing in real estate for all the reasons. If you do it right, you can create cash flow, tax benefits, and long-term growth. But let's face it, most folks have busy lives. You're doing whatever you need to do to live, thrive, and survive, and learning about real estate on the side, maybe investing on the side. The majority of people are not full-time investors. Now, sure, you'll hear a lot of full-time investors on our program because those are the folks that have learned all the distinctions and strategies that have helped them become uber successful. But the great thing about real estate is slow and steady wins the race. If you'll commit to the process and you'll get educated and put the work in at the beginning, then time becomes your best friend. Over time, your properties go up in value. Over time, your cash flow goes up. Over time, your loan payments get paid for completely by the tenants. And along the way, you get some amazing tax benefits, but you don't have to do it full time. So today on the program, we're going to talk about investing passively. That doesn't mean you don't have any work or that you don't have to get educated. But what it does mean is if you'll just do a few things at the beginning, then you can almost set it and forget it. And when it comes to passive investing, there's kind of a couple ways to do it. One is you can invest with somebody else. You can invest in a publicly traded stock of a home building company. That's exposure to real estate. You could invest in a REIT, a real estate investment trust. You could invest in a private placement, a real estate syndication. And so those are really hands-off investments. You research the market, you analyze the investing thesis, and you make sure that the folks who are running the deal are solid. But the other way to invest passively is to invest directly in properties and put together an awesome team, boots on the ground, that can get the work done from day to day. Managing the property, scheduling repairs, moving people in and out, and monitoring the progress and accounting for it so you don't have to. And that's really what we're going to talk about today. Our guest started his real estate career as a very hands-on guy and has learned quickly that there is so much power in passive investing. So whether you're an active or passive investor, you're going to get some great nuggets on today's show. When we come back, you'll meet Jim Sheils today on the Real Estate Guys radio program.
Hello, I'm Brian Tracy, and I'm here today with Robert Helms, and he always has wonderful ideas to share with you that can improve your life, improve your income, and help you to achieve more than you ever thought possible.
Welcome back to the Real Estate Guys radio program, now in our 28th year of broadcast. So many great ways to invest in real estate, but for a lot of busy folks, the allure of passive income makes a ton of sense. You do a little bit of work up front, get yourself into an opportunity, and then you hire teams, and you don't have to do much work after that. It sounds like the holy grail of real estate. We're going to meet a guy that does a lot of it right now. Welcome back to the Real Estate Guys radio program, Mr. Jim Sheils. Hey, Jim.
Hey, Robert. Good to be here.
Hey, it's good to have you here. You know, you meet all kinds of real estate investors, and some are very hands-on, right? Folks that are in acquisition and rehab and development and all that. But there is certainly a magic of figuring out how to get passive income coming in. And you've kind of learned this the hard way, if you will. Tell us your story.
Yeah, I really wanted to go off on my own, Robert, shortly after college. I had that entrepreneurial flair, that drive, but what direction to go into? And I'll tell you, I had a really interesting quote that was shared, a stat. And that is at that time, 7 out of 10 millionaires in the US made their money in real estate. And I liked that number.
Yeah.
And I started to look around. And I remember a friend of my parents who did some investment properties took me to breakfast. And he said to me, Jim, I was 22, Robert. And he said, you want to start looking at income producing real estate. I didn't know what the heck that meant. It sounded pretty cool, but that really started the journey. Just hearing someone say, this is what you might want to look for, and then seeing that one stat. And as I looked, unlike where I was in my first corporate job, it seemed like, as you made your way up the corporate ladder from the entry level to, let's say, 4 more levels to that senior VP, well, they were working almost double the hours that I was, and I was working a lot of hours, and I didn't like that. But the more that I started to study and get mentorship in real estate, it seemed like, do you remember, Robert, when you'd go onto the playground with your kids or as a kid, and they had the merry-go-round thing where you get on, it's kind of the wheel and you spin it. Well, when you're first like pushing that merry-go-round, right, you got to put your shoulder into it and dig your legs and you push it, push it, push it. And then it starts to go. And then it's more just that one hand where you're just, that one hand is just keeping it going. Now it's going.
Yeah, it's got some momentum.
It's got some momentum. And that's what I started to see about real estate investing. And when, I've listened to your show for a long time, when you really look at the longevity, there's never been a time in the US ever over a 10-year span that it was bad holding real estate ever. And so I thought, wow, if I can start young enough and start to plant these seeds and nurture and water them, it's going to be in my favor. 7 out of 10 millionaires. Now this stat is 8 out of 10. And then kind of that merry-go-round effect. I'm going to put my shoulder in and drive, and then it's just the hand kind of keeping it going. And that's what I see. And the good news is, too, that kind of putting my shoulder in and driving, all the blood, sweat, and tears you and I have learned over the last 25 years, I don't think it has to be as hard for people. But that was kind of my thought process for real estate.
Well, I love that. And the fact that it is hard at the beginning. You have to get that momentum started. You're pushing a boulder uphill and people get discouraged. They listen to some podcasts. They maybe go to a seminar or two. They read a great book, and we'll talk about one of those before we're done. But it's just daunting. There's just so much to get done. But it's great to see someone on the other side of that who acknowledges it is hard at first. But once you get going, that momentum works on your side. And, there are a lot of folks that want to be active in their real estate investing, and nothing wrong with that, right? We hang out with a lot of folks who are actively pursuing real estate, many of them full time. But a lot of people have a thing they love to do in their life. Maybe they own a business. Maybe they work for a great company, and whatever they're doing to live, thrive, and survive makes them enough to, feed their kids and go on vacation. But if they can just put a little bit aside, that passive income through compounding can get massive.
Yes. And that's the people that, we've worked with. I have a lot of friends that are in the trenches, and they started with me in the trenches and they're there. But we found that, like you said, Robert, a lot of people don't want to do that, whether it's they love their career. Like we've worked with a number of doctors. They love their practice, but they want to have something to fall back on in their practice in years to come. They don't need it now, but in years to come. I also have a lot of friends, for example, they have really good businesses or tech jobs or other such things, let's say out in California. And they love the lifestyle in California, but they don't really like the landlord laws or the pricing. So they don't want to move to where they have to invest, if that makes sense. And I know you've been a master at helping people not do that. But that's another reason why I see people saying, look, I want to be exposed in real estate, involved in real estate. I believe in the principles, but I truly want to be passive, meaning I don't want to pick up my life and move to an area and be handling my own management in this backyard that I don't even want to live in.
Nothing wrong with that for folks that gravitate to it. But I think passive income, I tell you, the longer I'm in real estate, the more I appreciate the passive deals that don't take that much doing. Now, it still takes work. You got to find the right marketplace. You got to find the right team. You got to figure out, do I need a property manager? And if so, how do I get a good one? And I know you guys have been through some kissing of the frogs, if you will, finding managers that weren't great. But the other part is, when you're starting out, you might not have a ton of money. And so you want to build up some sweat equity. People do that by fixing up houses, by carpeting, by painting. You did a bunch of that. You had some rehab projects when you first started out.
Oh yeah. That was my niche. I would buy, fix, and either rent out or resell foreclosures. That's what I did. And I learned a lot of lessons, Robert, and it really got me clear on a couple of things that yes, this model works, but yes, it's a lot of work. How did I want to change for when I was going into my family life? At your last event, you're wanting to spend time with your son. I'm wanting to spend time with my children, and that time is fleeting. And so I wanted to really gear my own portfolio and my own niche to match that ability. I wanted to buy back my time because, well, let's face it, some of us who do the work on our own, we can get so caught in that grind, we forget to enjoy. Or we don't even try to course correct, make some changes to our niche that can hopefully help us step back some, guide the ship a little bit differently. I don't know if that makes sense.
Absolutely. Investing can be something you do part-time. Investing can be something you devote a lot of your time to, like both of us do these days, but it really is designed to support your lifestyle, not become your lifestyle. There's not too many full-time real estate investors, and some of them basically are on the hamster wheel, and they're making money and they might not enjoy it. But instead, I think if you design a lifestyle around real estate, it can be awesome.
Yeah. It's funny, Robert. Again, just to go back to a simple example that we all get, I have some really good doctor friends, and let's say they've built a good practice and they're doing well. They're making over $500,000 a year, let's say. And they've come to me and said, hey, I'm thinking about giving up my practice and just going into real estate full time.
Wow.
And I said, well, and this was something a mentor taught to me, the first thing you would need to do is replace that hefty income. So you're starting behind the eight ball.
Right.
And they stop and they go, oh, you're right. I said, so the first, just to get back to par, you would have to replace either flipping houses or wholesaling if you're going fully into real estate, because, rental income is more of a slow growth, as we know, planting the seed. And we would get deeper into the conversation. They said, wow, that would be a lot of work just to get back to par. And I said, now, why wouldn't you more step in like on that merry-go-round, not putting your shoulder into it, get on someone else's who's in the trenches all the time, and you're just doing this. You're just doing that little hand flick, using your well-earned money in your practice or your business or your, well-paying job, start planting the seeds and make that transition. You don't have to do the leap like everyone talks about. And thankfully, a lot of doctor friends didn't. Now, I've seen a few that did, and I can't say the results were always gratifying.
I could see that for sure. For a while, we were developing a product that was mostly purchased by doctors and dentists, and we'd show them how they could own the building that they were in instead of leasing it from somebody else separately. And some of those doctors went on to sell their practice and keep the building, right? So all kinds of ways to play in real estate. And now that which was an active business for them becomes a passive investment. So this isn't a one-size-fits-all. But I think the exercise today is to get your mind around the fact that you don't have to trade time for dollars. When you start out, yeah, you probably do. But you get to the point where, in the best part of real estate, you buy an awesome property in a great market, you get a professional to manage it, and then the tenant slowly but surely pays off your mortgage, and hopefully a little more besides. You're making a little cash flow on it. And then one day you've got a free and clear property. And talk about passive income then.
Yes. That is a nice journey as the cycles bring you forward. And there's setbacks, as we know. You and I went through 2008. But as the cycles bring you forward, when you look at properties go to the point of free and clear, or, overall portfolio starts to go down in LTV, loan to value, that's a nice feeling, Robert. When I remember when my overall portfolio, I have free and clear properties, but then the overall portfolio went below 30%. I was like, wow, this is what we planted the seeds and watered for. And it takes time, but you can get there. And great things happen. The cash flow has grown. The values have grown. So if you do want to leverage some more off and dump into more properties, and again, you can do this in a way, and I think it's not just real estate, Robert, it's what kind of real estate will help you stay more passive instead of being more active.
Well, that's where the voice of experience comes in. In fact, last time we had on the show, you were just about to release your book. You came out to our syndication event, and it had just come out. This is your brand new book, and you and your wife, Jamie, have put together the Passive Income Playbook. Really enjoying this book, and before we're done, we'll tell listeners how they can get a copy of it. But it is a mindset, and when you've gone through what you and I have gone through over the years, trying out things that took maybe more time and didn't make as much money, you get to that point where the more hands-off I can be, the better. But it does bring up an interesting point. Not to say there's anything wrong with finding a fixer-upper and doing the work and forcing some equity and either hanging on to it or selling. You've done a bunch of that. I've done a bunch of that. But I'll tell you, for me, I like brand new, beautiful properties with builder's home warranties.
Yes. And that's what I've grown to like. And the gym sitting in front of you today, Robert, is very different than the gym of almost 25 years ago starting out.
I can relate so much to that, right? I was a C-class guy when I started, and I bought stuff in neighborhoods. Well, you didn't have to carry a gun, but you better have a knife with you. And today it's exactly opposite of that. And, the challenge, of course, with new property is finding it, because it's not everywhere. Most resale properties dominate the market. And then finding the inventory, even if you have a great market and even a great builder or developer and property manager, there's not always something available. And over the years, we've seen folks have to, wait in line. And that's okay, right? Because again, we're talking about getting wealth slowly. But our favorite thing of the real estate guys is to learn how to collapse time frames. So you and my good friend Chris have been in the rehab business together and now in the build to rent business. And this really is new property designed for a tenant.
Yes. And we call it the Turnkey 2.0 because Chris and I, as you know, did a lot of bulk foreclosures, which sounds exciting. And it was. It's a great niche. Again, like you said, fixer-uppers. But the ROT, the return on time, was very, very intense. And that was a choice we made, and it got us into that really first level of positional wealth, and we're very grateful for that. But what we found for us and our investors, it actually became out of a need. The fixer-uppers, especially like Jacksonville, Florida, where you've done a lot, the fixer-uppers really started to go up in price. And we were the numbers weren't making sense. And Chris, to his credit, came to me and said, hey, what if we built our own properties and started to fix up old ones? It was literally that simple of a question, Robert. So the term build to rent didn't even exist.
No.
And we said, okay, let's try this one neighborhood. And again, this is almost a decade ago. It was 28 houses. I know you guys were involved, and we learned some lessons. It didn't go perfect, but we saw something here that really, really caught our attention. And that was the potential of saying, wow, we're in better areas, longer warranties. We've heard that tenants stay longer with these types of properties. They are attracting a better tenant overall. The growth patterns are stronger than the C neighborhood. So we could go again, put an A property in a B neighborhood with that great mixture of homeowners and renters, walk down the street 9:00 on a Friday night and not have those problems. And we could also design it where I love the money pit, Robert. Did you ever see that Tom Hanks movie? I mean,
yeah.
2 weeks.
Another couple of weeks.
Yes. And so that's the rehab game. It's a great game. I'm very appreciative of it, but there's always surprises. And I don't like surprises. And we certainly don't like surprises for investor clients who are busy in their own businesses. We found that a lot of the surprises went away, and we were able to get people further in their financial goals, those passive income goals, with less property numbers and better quality properties, if that makes sense.
Well, the thing about buy and hold investing is the hardest part is the very beginning, right? When you buy the property, that's when the LTV is the highest. Over time, your tenant's going to pay down your mortgage. Now, maybe you refinance at some point, but if you don't, that's the hard time. That's when it's tight on the numbers. That's when everything is rough. But as time goes by and equity happens and inflation is persistent and you raise your rents little by little while your mortgage amount is being paid down, then the magic starts to happen. Well, how do you collapse that time frame? You find something that doesn't have any deferred maintenance and in fact has a warranty on almost every component. And then the management. And this is huge. I remember the first time I had talked to Chris all those years ago, he really was explaining his frustration in finding a competent property manager in the area, which led very much in a parallel story to starting his own property management company. And today at Suncoast, you guys manage a bunch of properties. So if someone decides they want to invest in a new home that you build, they aren't obligated to have you rent it for them, but it makes a ton of sense. Nobody knows the product better. Nobody knows the areas better. And so it's really been awesome to watch this blossom. These two companies that you have, Southern Impression Homes that builds houses and quads and all kinds of neat properties, and then Suncoast Property Management, because the property management can make or break a passive deal.
Absolutely. I remember my first mentor, Robert, in real estate said, Jim, you can buy a house at 50 cents on the dollar, and if you don't have management, you can lose money. And that always stuck with me. And so we thought, how do we get better management? How do we, and again, we don't mind making things easier on us or other people. And so we said, how do we make management easier? Well, if you go into better areas, have better properties of better condition, you attract better tenants, have less turnover, less maintenance and repairs, especially going with the new construction model. And we have no problem. In fact, as you know, over the years, we made some very conscious decisions, Robert, as we grew Suncoast. It was very exciting, but we also started to grow into properties that we were being referred to of C, D, and D- levels.
Yeah.
Chris and I made the decision a few years ago to say, we wish you well, but we don't want to manage those because they took so much effort away. We said, we want to focus. So 90+% of what we manage is now new construction. So we're able to really focus on this type of product and also give the best service to the people we work with.
Now, sometimes people think, well, a new property might cost me a premium. It might be more expensive. And I'll tell you that can be true. But the other part of that is when you have a brand new property, it's more attractive to tenants. The tenant who's out looking at 3 or 4 townhouses or houses or units is like, ooh, the new one. It has that new house smell, right? So at least the first a couple of times you're going to get that. But also the fact that when people are looking to move, it's usually because either they've outgrown the property or something just isn't being taken care of. And you eliminate that. So length of tenancy is critical. The two most expensive things in buy and hold real estate are turnover, what you have to pay to get it ready for the next tenant, and vacancy, when there's no one in there making the mortgage payment but you. And so this is one of those clever ways to shorten both of those things. A little less turn cost and certainly a little less time on the turn.
Yeah, I mean, Robert, you're hitting on some main fundamentals here. And one thing that we've learned, I agree totally. I like to look at buy and hold long term. And you hit the nail on the head that those first years, you're just catching your bearings. You're just starting to move forward. So when we were doing our old model, Chris and I, of fixing up foreclosures and renting them out for ourselves or working with investors, our average tenancy was a little over a year.
Yeah.
Now, our new construction model, and this is updated statistics, our new construction model with our new construction properties, the average tenancy is just over 3 years.
Wow.
So when you look at that, when that initial phase is so important, Robert, to really, again, get the wind at your back, and those first few years are so important, we know if we can lower the turnover, have that longer tenancy, that for me personally, like I talked about, where I like to now own less of better quality, I, Robert, looking long-term, now will always sacrifice some cash flow up front for what I could get on maybe a C or D neighborhood and go to a B and A and sacrifice that cash flow up front, because from my experience now, what I sacrifice up front, I will have less headaches in those first few years, which will cost me less turnover, less maintenance and repairs. And then if I have that patience of just a few years, the rents in these more solid, desirable areas seem to jump well. The values have jumped well. And that just gets me on a better trajectory. And then when you start to look, and I know to some people that sounds, oh my gosh, 7, but 10 years down the road, you're sitting in a very good position with not, again, we want that passive. We want to just be doing that merry-go-round just with our hands. And that's what the nicer properties have done. But there is some sacrifice up front that I had to take and believe in the fundamentals.
Well, that is a golden nugget, because I'll tell you, most people get focused on cash flow. Well, what's the cash flow going to be? But I would argue that more than 90% of those people don't really need the cash flow. They have that successful job or business. They want to put real estate in their portfolio, but $200 a month ain't going to make a lot of difference to them. So if instead you buy a property that maybe breaks even, doesn't put a lot of cash in your pocket those first couple of years, over time, it will start to. As more time goes by, even more so, as the mortgage gets paid down, not the way you pay it down on your own house through your own labor, but by the tenant, then you get to the point where you own a property that's free and clear. Talk about cash flow. Now, you may never get there. You may decide to sell or do a 1031 or something like that, but the mindset is different. See, one of the things about real estate is it has friction. When I go to sell a property, it's going to cost me 6, 7, 8% in closing costs and commissions and all that, and that's all great. But if I hold on to it and the tenant doesn't move out, that's when the magic starts to happen.
Yes, that's when the magic starts to happen. And as you and I have both experienced, that's when you've now planted the seed. You have a solid soldier performing for you. The equity has gone up, and you can have that disciplined approach that you've been teaching for years, where now we can responsibly leverage off of our own asset, refinance some money off tax-free, let our tenant pay for it. And what do? We put it into that next quality property.
Bingo.
That is exactly the model that I followed, that Chris followed, and so many of our most successful investors have. You're not recreating the wheel. You're not the first person to try this concept. It's worked for so long. And again, I like to say the solution doesn't have to be as complicated as we've made the problem. This works. And unless history is going to not be an indicator of future, I think it's going to continue to work.
Our guest is Jim Sheils. We're talking about investing as a passive investor. There's a lot more to talk about, like how to pick an awesome market. Plus, when we come back, we'll play real estate trivia and give a copy of Jim's new book away. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
As I speak, inflation is robbing you at a rate north of 10%. Last year, the number one zip code that Mid-South homebuyers offered income property to Real Estate Guys listeners in appreciated by 21%. To harness that spread and protect and grow your wealth in the current economic storm, you need the 2 decades of experience in renovation and management that Mid-South homebuyers brings to their investors. Every home Mid-South offers you will have brand new components, a new 30-year roof, and a high-quality renter, all in a price range under $150,000. Their empathetic property managers will use your ROI as their North Star, while the lack of repairs on their totally renovated properties contributes to their almost 4-year average renter stay and 99% occupancy rate. Learn about their lifetime occupancy guarantee and total 1-year maintenance guarantee by emailing midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com. You'll be glad you did.
Having trouble finding deals where the numbers make sense? Invest in an asset class that delivers cash flow to you in good times and bad, and where most of that cash flow is tax-free. I'm Dave Zook. Many of you have heard me speak at Real Estate Guys events or heard me on their podcast. My team is a top 5 ATM operator in the country, and right now accredited investors can make cash flow returns well into the double digits and get huge tax deductions. For your free report on this lucrative asset class, email atm@realestateguysradio.com.
Hey everybody, it's Ken McElroy, and I'm on with the Real Estate Guys, and I'm very excited to be a guest and a speaker at the Investor Summit coming up. If you haven't signed up, be sure to do so.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. There is still time for you to join us at the 22nd Annual Investors Summit at Sea. This is an extraordinary event, the pinnacle of Real Estate Guys events. It happens June 13th through 23rd. You heard that right, 10 days. We're going to start in Fort Lauderdale, Florida, a couple nights in a beautiful hotel, then jump on a brand new luxury cruise ship and go to Aruba, Curacao, and Bonaire with folks like Ken McElroy and Daniil, sales legend Tommy Hopkins, the rebel capitalist George Gammon, host of the Creating Wealth podcast Jason Hartman, editor of the Gold newsletter Brian London, and the one and only Peter Schiff. Plus lots more. You can get all the details by sending an email to summit@realestateguysradio.com or go to investorsummitatsea.com. We're talking with Jim Sheils about passive investing, fun and profit for busy folks. Before we get back to that interview, it's time to play real estate trivia. That's your chance to win a prize. If you know today's real estate trivia question, in just a minute, I'll give you the question. As soon as you know the answer, send your best guess to trivia at realestateguysradio.com. You'll need to give us your name, the answer to the question, and your physical mailing address, because if you win, you're going to get an autographed copy of the Passive Income Playbook by Jim and Jamie Sheils. I'm almost finished with the book. I am loving it. You're going to love it. That can be yours if you know today's real estate trivia question. Last week on the program, we had economist Mark Skousen with us, who is a direct descendant of Benjamin Franklin. So here is our trivia question. Most people know Benjamin Franklin for his work in the great state of Pennsylvania, but he also served as the U.S. ambassador to two countries. Which two? Well, the answer is France and Sweden. Franklin was the first United States minister to France from 1779 to 1785, and was also the first United States minister to Sweden from 1782 to 1783. Ben Franklin was a worldly guy. Here's our real estate trivia question for this week. Jim's company is headquartered in Jacksonville, Florida, and we're going to be headed there for a field trip in September. Here's what I want to know. Who is the city of Jacksonville, Florida, named after? Yeah, Jacksonville wasn't just a name they pulled out of a hat. It was named for somebody. Who was that? If you think you know, or you just want to guess, send your best guess to trivia at realestateguysradio.com. Trivia at realestateguysradio.com. Give us your name, your guess, and your mailing address. The first person that gets it right gets an autographed copy of the Passive Income Playbook by Jim and Jamie Sheils. That's today's real estate trivia question. We're talking about investing passively as a real estate investor. We've got Jim Sheils with us. And Jim, you know, we've hit on some really important parts about just understanding real estate, how it works, and the mindset. Of course, real estate is physically located somewhere, and not all markets are created equal. So let's talk about that side of the equation. You can have the greatest property in the world, but if it's in the wrong market, it's also not going to perform very well.
Absolutely. And we talk about in my book, Robert, the success indicators. I don't depend on appreciation. I know you've heard me say this, but I like to do my best to get in its way because it's really nice when it kicks in. So the fundamentals that I were taught was, where is the population growth? Where is the economic growth, the jobs going? What's the affordability look like? Affordability index is key. The average family income compared to the average price, is that healthy? Because that usually brings in cash flow. Or, you know, is there something desirable bringing the people to the area? Do people want to live there, and why? And then also the old supply and demand, Robert. I don't want to go to a market that is an oversupply of houses. I want to go where there's areas people are in the counties and the municipalities are yelling, will someone please build us some rental property? And that's where we try to stick to. And as you know, we found all of those fundamentals here in Florida.
Florida has been a great market in that respect for a long time. Net in migration, the number of people moving in minus the number of people moving out, has been positive for a long time. And, you know, the greatest shortcuts I found in market selection are two things. Net in migration, go where people are going, and tenant-landlord law being favorable to landlords. And you kind of check both those boxes in Florida.
Very important, Robert. And this is where I believe in teamwork. And that's what, you know, we always encourage. A lot of people would say, yep, Florida, no, it's growing. Yep, I like friendly landlord laws. That makes a lot of sense to me. But then they say, okay, I'm going to go to Miami. I'm going to go to Orlando. I'm going to go to Tampa. And Robert, there's three places we don't build: Orlando, Tampa, or Miami. Not that those aren't nice markets. Not that I don't think that's a big part of Florida, but we go where the growth patterns are occurring, into more of a second tier, but also where we're going to be able to get you in with stronger fundamentals. And where's the biggest need for housing, where there's also new construction can actually cash flow. So that's something that really deciphered too. When you look at first look, you might say, I have to invest in those three big markets. As you've known, because you've been with us for a decade, we took a different approach, and it's been a sound decision.
You know, I have to admit, I had never been to Jacksonville. I kind of knew where it was on a map, but first time I came in, What a clean, beautiful, nice place to live, on the water, diverse economy. What are some of the highlights of Jacksonville, especially as it relates to having a strong place for tenants to live?
Yeah, Jacksonville has always had a really good base of replaceable income. The type of jobs where, if a senior vice president of a marketing company loses their job, Robert, well, it's going to be hard to find a job. But for our port industry, for our tech industry, a lot of these more ground level employment, they'll be able to afford our houses. And if they lose their job, get another one. And we're not just dependent on, one industry. Like, to give an example, there's some great places to invest in the Midwest, but I was always a little shy of a Midwest town that had one Army base. That made me nervous, Robert, because what if the Army base closes down? So not only do we have 24,000 military, but we also have a multi-billion-dollar international port industry. We have a trucking and train industry here. This is the only spot in the U.S. where 95, which goes from Miami to Maine, intersects with I-10, which goes from Florida out to California. So that brings in trucking, that brings in train, which, Warren Buffett himself is very invested in the railroads, and CSX, their headquarters is here in Jacksonville. We have a tech industry now here. We have not hospitality, which is, Jacksonville's interesting, Robert, because you said something before, and these words rarely go together. Affordable coastal city.
Right.
You don't usually hear those together. So the fact that we have many branches we have probably one of the most diverse economies in Florida, that means if one industry starts going not so good, well, there's a lot of other industries in the area to be supporting the overall economy.
Now, as much as we love Jacksonville, you guys are also pretty strong in a couple of markets. A few years ago, we did a field trip and we spent a day in Jacksonville and then went down to Ocala, Florida, which, again, I had no idea about. But what an amazing place that is.
Ocala's, to Chris's credit, my partner brought us there. And remember the first time Chris said, let's go build an Ocala. And I said, isn't there only like 10,000 people out there? And I was dead wrong, Robert. As you know, there is a huge industry of not only shipping logistics, the largest equestrian center in the world was built there, which I know you saw and is quite impressive. Yeah. And not only does it have its own economy and our most affordable market in Florida with the lowest hurricane zone. But again, it is just south of Gainesville, which, there's UF and many other industries. And it's just north of the Villages, which is the second fastest growing and overall sized retirement community in the nation. So we have a lot of bedroom community participants that live in Ocala and then go down there to work. So it's very well located. And also, it's an affordable lifestyle, which people really like. And again, what does affordability do? Well, it allows cash flow, and it's got great cash flow coming out of that area.
Now, you're in some other Florida markets as well, and rather than just list them all, if folks are interested, we'll tell them how they get a hold of you before we're done. But I think it's a way to play diversity as well. If you are going to buy more than one property, it could be in the same city, and there's some reasons to consider that. You have a team in place, you know the market. But one of the diversity strategies is to be in markets that have different drivers. And so I like that perspective as well, because not all markets are created equal and they change over time.
Yes. And not only that, with the goals that Chris and I have set, right now we own over 5,000 lots in Florida, and those lots are not all in Jacksonville. And honestly, Robert, with our menu of single family, duplex, and quads, if we tried to do that amount of quantity in just say Jacksonville, well, we would have had to go to tough areas. And as you know, one of our rules is we've tried the tough areas. That's just not for us. I know it's some people's investment niche. That's not where we want to go. So if we're going to grow this build to rent business the way we want to, we need to go into markets that have the fundamentals I described, but we also need to go into multiple markets. That was an absolute must to be able to stay in those A and B areas, which we prefer to invest in. We couldn't do that all in Jacksonville. So for the size we wanted to take this, we had to expand.
Well, and Jim, there's an important point here for folks to understand as well, and that is to build something takes a tremendous amount of infrastructure. If I'm going to build my own house, I'm going to hire a general contractor and I'm going to pay a premium for that and so forth. But you guys have gone the other way. You figured out how that building more gives you those economies of scale. It lets you have stronger vendor relationships. It helps the property management side because you can have the same look and feel and materials in many, many of the properties, and it doesn't affect the tenant negatively, and it affects management positively. So it's not just, hey, these are new properties, but I think one of the unique selling propositions, and you mentioned this, but I want to make sure the audience doesn't miss this. There's a lot of builders that are anxiously trying to get into their next 20 or 30 or 40 lots. You guys over the years have actually sold to some of these builders, many of them national builders. But you've got more inventory than most people do. And this is one of the challenges. When markets get strong, when there's a good reason people come to rent a house, finding the inventory is difficult. And that's just not a problem for you guys.
No, we took a pretty big risk, Robert, and you were part of it. When 2020 got off to its start and the craziness of the pandemic, we had a very big meeting and we said, we're either going to be very right or very wrong, but we believe this is going to be good for real estate, especially certain markets. And we raised up and went into tens of millions of dollars worth of land.
Yeah.
And that could have been a big risk that we took. And sometimes you got to take risk. We decided on that. But now it's a risk that all of the victory gets to be shared with our clients, because where most people are trying to get land at the right place where they can build on it to make sense, we have a plethora of lots at this time, and that all is because we made a big decision. And sometimes that's something you have to do in real estate, these big decisions. And sometimes, again, that changes. A big decision for me 25 years ago was that first triplex I bought. For us, 25 years later was that land. But that put us in a position, Robert, where a lot of people are, as you said, scouring for land. We don't have to do that. We can focus on building. And of these lots we have, where's the most need right now? Where can we get things built the fastest that make the most sense? So we're in a very good driver's position.
Well, and unlike a builder that has to just rely on a bunch of third-party information, when you have your own property management company, which is substantial, you get real rubber meets the road details on where people are going, what's the trend in asking rents, how long does it take to rent units up, all those things, which I know you take that intelligence and use it on the development side, which is awesome. I do want to, before we're out here, talk about the elephant in the room, and that is interest rates. Interest rates are high, and it's harder and harder for people to make sense out of investment property. An investment that might have worked with 20% down 4 years ago to today's interest rates does not. The good news is you guys have a pretty fabulous solution.
Yeah. So we had so many investors say to us, gosh, I wish I had locked into a rate before June of 2022, because me and you watched it go through the hockey stick.
Yep.
So Chris and our team sat down and said, what do we need to do? How could we actually do that? And we got introduced to something we hadn't done before. And that's not only are we in the building business and the property management business, but we're in the money buying business, where we are in a good position with our balance sheet and financial stability, where we're able to pre-buy large chunks of money, which is called a builder forward commitment, where we're able to buy these lots of money, mortgages for our clients, and pass the savings along to them. And so right now, again, we've tried to make that wish come true, where, our people are locking in on a single family duplex or quad at 4.75%. And most people say to us, that has to be a trick. That's not possible today. I just got quoted from my mortgage company who's great at 2-3 points higher than that. But the fact that we're pre-buying the money and we are doing it in large lots, that's how we're able to buy down the rates. And as you said, Robert, the ability to be able to do that right now has kept our properties at a positive cash flow status, opposed to otherwise possibly a negative cash flow status. So the interest rates have been very important. And one of the best things we offer, besides that new construction quality and property management, is this new addition, which is our own in-house financing product.
And what that does is affect the cash flow at the beginning, and then over time, of course, just making that first push on the merry-go-round just a little bit easier. And, a builder can do that. And people think, well, they probably just raise the price of the house. But that's not how it works, because you're able to buy these forward commitments. You don't have to raise the price of the house. And even though you guys are in the business of building to make money, your margins are a lot lower, because you recognize that an investor is going to buy more than one over several years, most likely.
Yeah. And most of the large builders, people say, well, why don't the large builders build these type of homes or these duplex or their quads? And the reason why, they don't like our name, low margin.
Right.
Most of the big guys are high margin builders. We are a low margin builder, and we have this philosophy since the start. What we do in volume will make up for our lower profits per deal. And it's been a solid model. It worked for Walmart, and not that Walmart's my favorite place to shop at, but it's been a good philosophy for us. And the fact that we're able to take lower margins and do volume, it continues to grow our investor base and grow it very happily.
Well, it's probably not surprising to people that you have the added benefit of the fact that most of the folks that buy new property from you, single units, double units, 4 units, are going to have you manage it. And that's a stream of income as well. And it's really synergistic in that way, which is awesome. Well, hey, before we get out of here, we are super excited to be coming back to Jacksonville for a Real Estate Guys field trip. We're going to get down and kick the dirt. One of my favorite things to do, hang out with listeners in a cool market. And this is going to be a lot of fun.
Yeah. So we're inviting the whole gang back down here again. You guys have done a few tours with us. We love visitors, Robert. In fact, my only advice to you is if you're looking at a market and someone tells, don't come and visit, you don't need to do that, I think your red flag should go up. We love visitors. Come meet the team. Come see the projects, from start to finish. Come see the different type of properties and how they work. Have a panel discussion with our team, anywhere from the development side to the management side to the financing side, and meet with other investors. And on these 2 days of tour, you're going to be able to get a feel of not only the fundamentals we look for in Florida, the type of build that we do, the way that we manage, and the overall outlook growth that we're seeing in our markets. You're going to, as Robert said, get to have some fun and also, get to see a beautiful part of Florida that a lot of people miss out on.
So much to love about Florida in general, and especially in these little niche markets. So come join us for the Real Estate Guys field trip to Jacksonville. You get to meet the team at Suncoast, the folks who will be managing the property for you, and you'll get to meet the construction team, and we'll see some houses. But more importantly than seeing units, we're going to see the market. You're going to understand the drivers. You're going to see why it is an attractive place for tenants, that affordability that Jim's talking about. I mean, just hanging around, you get to see that. If you come from a place where it's expensive to live, it's almost sticker shock, reverse sticker shock when you go to Jacksonville. And it's not just Jacksonville. There's some cool markets we'll go to in the surrounding area, and you'll get to meet a bunch of great real estate investors and all that. So if you want to join us, just send an email to Jacksonville@realestateguysradio.com. Jacksonville@realestateguysradio.com. You get the details for the field trip. Plus, we'll also send you a link where you can pick up Jim's new book. Hey, Jim, this was great stuff. Can't wait to be in Jacksonville and get to hang out with you and the team. And we appreciate you being on the program today.
Thanks for having me, Robert. Always a pleasure.
The power of passive investing. There's Jim Sheils from Southern Impression Homes. More when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
All aboard. Registration is open for the Real Estate Guys 22nd Annual Investor Summit. Imagine spending more than a week with like-minded investors, world-class educators, and real-world professionals. Returning in 2024 is the editor of the Gold newsletter, Brian London, real estate developer Beth Clifford, and the rebel capitalist George Gammon. Back with us in 2024, sales legend and best-selling author Tom Hopkins. And joining us live and in person for his 12th Investor Summit, Ken McElroy. Plus 2 brand new faculty members we can't even mention yet, and a lot more. It all begins June 13th in Fort Lauderdale, Florida. Visit investorsummitatc.com to get all the details and reserve your spot. This transformational week is like no conference you've ever attended. Go to investorsummitatc.com and make plans to spend a week with the real estate guys, Ken McElroy, Tom Hopkins, and an all-star faculty on the 22nd annual Investors Summit at Sea.
Hey, I'm Jim Grant. I am the editor and indeed the founder of Grant's Interest Rate Observer. And you, ladies and gentlemen, you lucky people, are listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, come join me in early May for a tour of Dallas properties with our friends from The Peak. You'll get to Dallas on the afternoon of May 9th. We'll get together that evening and get to meet all the folks and have some dinner. Then the next morning, May 10th, you'll learn about what's happening in the Dallas marketplace and then jump on a bus and tour some cool properties. To get all the details, just send an email to DallasTour@realestateguysradio.com. DallasTour@realestateguysradio.com. Well, we are big fans of getting out and seeing markets up close and personal. Great to hear from Jim Sheils today and learn more about his journey. He's really earned the right to have the opinion he does about passive investing, having been an active investor for so long and recognizing that you get the majority of the benefits of real estate without having to do all the work. Now, the reality is when you're a passive owner of property and you hire a property management company, it costs you something, right? If you were going to go collect the rent yourself, you might save 8 or 10 or 12%, whatever your property manager charges to do the work. But I will tell you, that is some of the best money you pay is to a property manager who not only handles the headache and deals with tenants, they're arm's length, so they're not emotional about the property. They're really good at collections. And should that fail, they're really good at evictions. Now, most property managers rarely have to go there. My guess is you'd have to go there more often because you don't have their expertise. If you happen to invest in the same market you live in, well, then maybe you could self-manage. And I'm not sure it would be a terrible idea to self-manage for a while so you get to learn the game you're in. But ultimately, you're going to have a portfolio that is too big for you to manage yourself, and you might decide to diversify into other markets. I always say live where you want to live and invest where the numbers make sense, which is why we'd love to have you join us in Jacksonville, Florida, September 13th, 14th, and 15th. It's going to be an amazing trip. If you'd like to get the details, plus Jim Sheils and Chris Funk's report on Jacksonville to learn more about the market, and a link to get Jim's book, all you have to do is send an email to jacksonville@realestateguysradio.com. That's jacksonville@realestateguysradio.com. Well, since we've talked a lot about a market today, we're going to take a little different direction right now, but it is time for this week's edition of Market Spotlight. Well, ladies and gentlemen, it is time for another edition of Market Spotlight. And because we've been talking about real estate markets today, Jacksonville and Ocala and places like that, this Market Spotlight is going to be focused on the metals market. What's happening in gold and silver? To answer that question, please welcome our friend Dana Samuelson. Hey, Dana.
Hi, Robert. It's great to be with you.
Well, it's always good to have you on the show, Dana, and tell us what's going on. I mean, the markets have been crazy. Gold hit a new high, then down a little bit, then hit another new high, then down a little bit, then hit another new high, up and down. Tell us what is going on with the metals markets.
Well, it's been quite a ride over the last couple of months as gold has finally broken out of a trading range that it's been in between $1,850 and $2,050 an ounce since COVID hit, and we had our great debt explosion where our debt increased $6 trillion in 1 year. Where 10 years ago our debt was $17 trillion, now it's $34 trillion, and interest rates were 0, and now they're 4% and 5% on that debt. So our debt service is going up. So gold's responding fundamentally to that as it's moved higher over 2050 for the first time in earnest to as high as 2,400 about a week ago. The first half of that rise was pretty fundamental based on the debt, higher interest rates, sticky inflation. The last $150 of that rally was more driven by the tension in the Middle East ratcheting up after Israel assassinated Iranian general on Syrian soil, which is something that, you just don't do, especially at a diplomatic mission. So that turbocharged the tension in the Middle East, with both Israel and Iran taking direct shots at each other for the first time ever. And that's really, I think, what turbocharged gold higher. Silver, too, went from about $27 to $29 an ounce at their peaks. And now that they've both kind of walked back, that they've had this exchange of fire, and they're downplaying further tension, the gold price is finally correcting. So we're seeing gold today hitting a support at about 2,300 and silver hitting support at about $27, which is where they should find support in these markets based on fundamentals alone, let alone the tension in the Middle East, which is still there. It's just right now the steam has kind of gone out of the equation for the short term. So the metals are on a solid rally that got a little aggressive because of what's been happening in the Middle East. And now we're seeing that back down a little bit. So the metals are finally getting some profit taking, which is healthy for any market.
Well, that's what I wanted to ask you about. When the price just kind of plods along, the reason we hang on to precious metal isn't because it creates a dividend or really is an investment. It's more of a hedge or an insurance. And we've talked about that on the show before. But when you do get this kind of price escalation, no matter what the cause, at your level, the street level, you're a precious metals dealer. What happens? Do people want to sell? Or are more people trying to buy? What does that look like?
Well, typically in the past, when we've had these really sharp rallies, it's been driven by financial fear, the great financial crisis, and then COVID. And that tends to bring the public in as buyers en masse because they have something to really worry about. And gold is the ultimate currency of last resort when there's economic or financial trouble. Now, this rally has been more fundamentally driven,
right?
I think by big players who understand what's really happening in the big picture. And then the turbocharging of it in the Middle East is not something that's really created a lot of here in the U.S. I mean, around the world it has, but not so much here in the U.S. So we've actually had a lot of sellers come into the market, taking advantage of the higher price. And the unusual thing about it is it's not the people that originally bought gold that are selling, in my opinion, from what I'm getting from my clients. It's more people that have inherited gold from the people that bought it. Now, the people that bought it, they bought it for a reason. They bought it to protect themselves for situations like we've just gone through. But the people that have inherited it, they see it as found money. And when gold hits an all-time high, they're happy to cash some of it, if not all of it in. And I do think inflation's taking a bite out of some people's ability to survive, and that's another motivating fear, but inflation's actually a gold price driver in the long run. The net result has been we've seen probably as many sellers as we've got buyers, and that's really an unusual situation for us to be self-supplied from our own clients rather than having to source from the market, the U.S. Mint, the Canadian Mint, the Austrian Mint. So it's a little bit different, but the fundamentals are still underlying this market, and the market will go higher over time.
All right, good stuff. Well, Dana, always great to talk to you. I'm excited that you're going to be joining us for the 22nd Annual Investors Summit at Sea.
Robert, I can't wait. This is one of my favorite weeks of the year to spend with you and your team and the faculty, and especially the people that come on the summit to learn, because as I've said many times, you have the most unassuming group of overachievers I've ever met in my life, and so much diversity of talent in the audience itself. Wonderful people that will help you, and it's a great way to build a network if you're a real estate centric of people that can help you in the future. You can do more in a week on the summit that you can do for yourself in 10 years of building a network of people you can rely on and help you in the future for every facet of real estate investing.
We also asked Dana to do an introductory session to the metals. So if you've never owned gold or silver and you want to learn what it's about, then you can hang out with Dana Samuelson on the 22nd Annual Investors Summit at Sea. Thanks, Dana.
Thank you, Robert. See you in a few weeks.
From American Gold Exchange, there's Dana Samuelson on today's Market Spotlight. There's Dana Samuelson. Hey, he's got a great report on understanding precious metals. All you have to do to get a free copy is send an email to preciousmetals@realestateguysradio.com. preciousmetals@realestateguysradio.com. Big fans of the investment benefit you can get when you understand how gold and silver can fit into your investing portfolio. Well, big thanks to Dana Samuelson and Jim Sheils for sharing with us today. Come join us in Jacksonville, Florida, September 13th through 15th. We'll have a great time. We'll get to hang out, and you'll see the market up close and personal. Jim will be there. His partner and our good friend Chris Funk will be there. You'll meet the property managers, the construction team, everyone who's involved in the entire process. Whether you decide that's going to be part of your active investing portfolio or passive investing. One of my favorite things about the field trip is the folks who come. We always meet super cool folks, so add your name to that list. Just send an email to jacksonville@realestateguysradio.com. Next week on the program, we're going to talk tax. Yeah, not in a bad way, but in all the tax advantages of real estate investing. Plus, we'll get a glimpse of what's coming on the horizon in the world of tax with best-selling author CPA Tom Wheelwright. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers, low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct, asset protection strategies for real estate investors from attorney and Rich Dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys radio show.